John, I want you to help us with the nominal reality of high inflation, some kind of growth, but how the stock market does when there's higher nominal GDP. What happens?
Right. Tom, when people see higher inflation, their assumption is that this hurts corporate profits because costs go up. And in reality, companies sell more in high nominal environment. What are we talking about? GDP is expected to be 3.5%. That's almost double the level that it's been at for the last 20 years. That's the consensus view right off of Bloomberg. And then inflation this year is expected to be high. And in those environments, stocks do well. But the key is certain stocks do much better than others. Energy, materials, financials, things of that nature do much better. Technology, which I love longer term, is not really a natural beneficiary of this high nominal growth environment.
So the narrative that's emerged in the last week or so, Jonathan, that you can't buy bonds right now because it's going to be worse for them than stocks. Stocks actually are your inflation hedge. Is that essentially what you subscribe to?
I do. Our call is actually that if you think about a corporate bond yield, that at the end of the year will probably be roughly where we are now, but the mix within that corporate bond yield is going to shift. So the 10-year Treasury probably goes up, 20, 30 basis points, and credit spreads come down because the system is going to feel less stressed as the year goes on. And so you may get the same bond yield in terms of the total, but how much of that comes from your Treasury, your inflation, your corporate spread, those things are going to be moving around a lot. They'll be keeping bond guys busy.
John, you put out a note last Monday. You said recession concerns legitimate but overstated. And on the Fed, you went through this piece by piece, the Fed, the yield curve. Let's start with the Fed. You said even if the Fed were to raise rates 7 times in 22, policy would still be too accommodative. Too accommodative for the market too?
Well, listen, the market probably always wants the Fed to do nothing and just to have lots of easy money. But the reality is that if inflation runs away from the Fed even more than it is now, we're all a lot worse off. I mean, if they raise rates, as they say they want to, 7 times this year, the Fed funds will average only about 1% over the course of this year, and yet nominal GDP is expected to be almost 9%. That just leaves the Fed actually adding liquidity to the market, not pulling it out. And I've heard I've heard Larry Summers talk about this, and Bill Dudley has talked about this, and Bullard's talked about this, that the level of kind of a neutral Fed funds rate that they're going to need to get to is much higher than right now the market is discounted.
John, very quickly here, are you suggesting sell Apple, sell Amazon, sell this, sell that?
No, I mean, listen, I'm neutral on those tech sectors. I think the key is that about 20% of the S&P is a really great inflation hedge. And that includes those cyclical sectors, even things like industrials and the like. However, the rest of the market doesn't do particularly poorly in this inflation environment. They just don't benefit as much. And tech is one of those areas that is kind of neutral in this environment. Tech does well, frankly. If you think that we're going to slow down and recessionary risk is actually higher, for those people who are more bearish, they probably want to roll into tech because it tends to do a little bit better if the economy decelerates, which I don't think it will.